If you've ever bought or sold a token on Binance, Bybit, or any exchange, a market maker was part of that trade. You just never saw them. Market making is the infrastructure layer that makes trading actually work. And whether you're a trader, an investor, or a founder launching a token, it quietly decides whether a market is smooth or unusable. So let's break it down. What a market maker actually is, how they make money, and why every token needs one. Let's get into it. Let's start simple. A market maker is a firm that continuously places buy and sell orders on an exchange to keep the market functional. They provide the liquidity that lets everyone else trade quickly, at fair prices. Here's what that means in practice. Without a market maker, you place a buy order and you might wait hours for someone to take the other side. Spreads get wide, the price jumps on small trades. For most people, the market is basically unusable. So in the simplest terms, a market maker is the participant that makes sure there's always someone willing to buy when you want to sell and someone willing to sell when you want to buy. So how does it actually work? The core mechanic is straightforward. A market maker places orders on both sides of the order book at the same time. A buy order at one price, a sell order slightly higher. The gap between those two prices is called the spread. When both orders fill, the market maker earns that spread. Simple example. A market maker buys a token at $1 and sells at $1.01. If both fill, they earn 1 cent per token. Multiply that across thousands of trades a day, across dozens of exchanges, and it becomes a real business, but that's the simple version. In reality, prices move constantly, so the market maker adjusts orders in real time based on price, trading activity, news, and each exchange's conditions. Every order carries risk because holding inventory in a volatile market means its value can change within minutes. Now, market making looks different depending on where it happens. The goal is the same, the mechanics are not. On centralized exchanges, Binance, Bybit, it's order book based. The market maker places specific buy and sell orders at specific prices and actively manages depth, spread, and compliance. That takes exchange integrations, API access, and real-time monitoring. On decentralized exchanges like Uniswap, liquidity comes from automated market maker pools instead of an order book. Anyone can deposit tokens into a pool and earn fees, but those pools are passive. There's no active management of depth or spread. A formula sets the price based on the ratio of tokens in the pool. Professional market makers work on both, but the approach is fundamentally different. Centralized market making is active and constant. Decentralized liquidity is more about how you position capital. On a practical level, market making comes down to 4 things. 1. Order book depth. A market maker keeps buy and sell orders across many price levels, not just the best bid and ask. That depth lets bigger trades fill without moving the price too much. Thin depth is what causes slippage, and slippage is what drives traders away. 2. The bid-ask spread. That's the gap between the highest buy order and the lowest sell order. A tight spread means fair prices. A wide spread means every trade costs more than it should. The job is keeping that spread tight while managing risk. 3. Exchange compliance. Every exchange has minimum requirements for depth, spread, and activity. Miss them and the token gets flagged with a warning label that tells traders it's at risk. A market maker keeps those metrics in range. 4. Cross-exchange consistency. Most tokens trade on several exchanges at once, each with its own order book. Without coordination, the same token can trade at different prices in different places. A market maker works across all of them to keep it consistent. So why does a token actually need this? A token without a market maker is like a store without shelves. The products might be great, but nobody can reach them. Here's what happens without one. The order book stays thin. Any trade above a few $100s moves the price. Spreads get so wide that traders just avoid the pair. Compliance metrics slip, the token gets flagged, and eventually it risks delisting. We've seen this pattern hundreds of times across more than 2,000 token launches. The projects that launch without proper liquidity management almost always hit these problems in the first few weeks. The ones with a market maker in place from day one look completely different. Healthy depth, tight spreads, exchanges satisfied, and traders able to actually buy and sell. Let's talk about how market makers actually get paid. There are 2 main models. The retainer model. The project provides the tokens and stablecoins. The market maker manages liquidity across exchanges and charges a fixed monthly fee, sometimes with bonuses tied to specific targets. At the end of the contract, all the assets go back to the project. The loan model. The project lends its tokens to the market maker. The market maker uses those plus their own capital to provide liquidity. And in return, they receive a call option on the loan tokens at a set strike price. No monthly fee. Their compensation comes from the value of that option. Both have trade-offs. The retainer model gives the project more control and transparency. The loan model has a lower upfront cost, but the incentives are different. Every project should understand both before signing with anyone. Here's the takeaway. Once you understand market making, you see the whole market differently. Every token you've ever traded smoothly, every tight spread you took for granted, every order book that had enough depth for your trade to fill, a market maker was behind it. For traders, knowing this helps you pick better pairs and avoid tokens with poor liquidity. For founders, it makes one thing clear. Market making isn't an optional add-on. It's the infrastructure that keeps your token alive, tradable, and listed. Not every market maker is the same. The quality varies a lot. Here's what to actually look for. Exchange coverage. How many exchanges are they connected to? A firm integrated with more than 90 has been building those relationships for years, and you can't shortcut that. Team and infrastructure. Market making is not just software, it's people. Traders, quants, and engineers working together. Firms that lean entirely on bots with no human oversight tend to underperform in exactly the volatile moments where active management matters most. Track record. How many tokens have they launched? How long have they operated? Can they show you real examples? A firm that's been through multiple market cycles has experience newer firms simply don't. Transparency. Do they give you regular reporting? Can you see the order book data, the spread performance, the compliance metrics? If they can't show you what they're doing, that's a problem. And legal structure. Are they properly registered and audited? Market making means handling significant client assets. Proper legal infrastructure is not optional. At EchoTrade, this is what we do every day. We're a market maker built by a team with more than 5 years in the space, integrated across more than 90 exchanges with over 2,000 token launches behind us. If you're building a token and you want to understand how professional liquidity management would work for you, send us a message for a free consultation. We'll walk you through it. Thanks for watching.